Welcome to the deep dive. You're here because, well, you want to get a handle on the big currents shaping our global economy.
Uh-huh. The forces, the challenges.
Exactly. And maybe find a few surprises. Think of this as your way to understand what's happening without getting, totally bogged down in data.
Yeah, we've looked through quite a bit, including recent UN reports, to pull out the key stuff.
Right. So, our mission here is simple. Give you a clear, jargon-free picture of the world economy now, where it might be headed, and maybe highlight some unexpected things.
Okay, let's get into it.
So what's the headline? What's the big picture?
Well, the immediate thing is this tension. You've got moderate growth overall, but alongside it, a really significant amount of uncertainty.
Okay, so growth numbers.
The global economic growth for 2024, the estimate is about 3.4%.
Right.
That's a bit of an increase from 2023, which was quite low at 0.9%.
A noticeable jump then.
And
for 2025.
the projection is similar, around 3.2%, but, and this is the key thing, this picture of steady, if moderate progress, is really clouded by anxiety.
Anxiety about what specifically?
Well, look at the Global Economic Policy Uncertainty Index. It's been ticking up. Yeah, especially in developed economies, people are nervous about trade policies, government spending, that sort of thing.
That makes sense. You hear whispers, potential trade spats, governments changing fiscal direction. It feels less stable.
It does, and it's not just a feeling. There's data suggesting the momentum we saw might be, well, fading a bit.
Oh, like what?
The Manufacturing Purchasing Managers Index, the PMI, it's a key indicator for factory activity.
Right.
It actually fell into contraction territory late in 2024.
Okay. So the manufacturing rebound might be running out of steam?
That's one interpretation.
Yeah.
And linking back to the uncertainty, the threat of higher tariffs, more trade restrictions, that's a real worry.
Because that messes with supply chains.
Exactly. Disrupts them,
Yeah.
impacts production costs, and could even, stir up inflation again.
Inflation. The topic that just won't go away. Seems like there's some good news there, but maybe not a complete victory lap.
That's a good way to put it. Global inflation did ease in 2024 compared to 2023.
Yeah.
But the speed of that decline, it slowed down.
Especially in wealthier countries.
Yes. Things like housing costs, services, those prices have been quite sticky, not coming down as fast as hoped.
And that has knock-on effects for central banks, I assume.
Absolutely. It directly impacts what they can or maybe can't do.
Right, because we saw many of them, the ECB, Bank of England, the Fed in the U.S., starting to signal maybe easing up on monetary policy in 2024, thinking about rate cuts.
They were. But this sticky inflation, particularly in services, complicates that picture considerably. It might mean they have to hold off on cuts or make smaller ones.
So the cure for inflation is taking longer than expected.
Pretty much. And interestingly, the Bank of Japan actually went the other way. They tightened policy.
Oh, okay. An outlier.
For now, yes. But for most developed economies, the risk that inflation could flare up again, well, it could mean those rate cuts are delayed or less dramatic.
Meaning interest rates might stay higher for longer than we thought. Maybe higher than pre-pandemic levels.
That's a distinct possibility. And don't forget quantitative tightening QT. Central banks shrinking their balance sheets.
Right. Selling off assets.
Which also tends to push longer-term interest rates higher. So, multiple pressures keeping borrowing costs elevated.
Higher rates. That definitely has a ripple effect, doesn't it? Especially for countries already swimming in debt. Let's pivot to labor markets. Developed economies seemed okay there.
Yeah, actually quite strong through 2024. Employment across the OECD countries, the wealthier nations, mostly was up 3.8% compared to before the pandemic.
That's significant.
It is. And another positive point. Female economic activity has risen, helping to narrow some gender gaps in employment.
Good. And what about wages?
Because labor markets were tight, we saw nominal wages rise. And with inflation easing somewhat, real wages, what your money actually buys, increased in most developed economies.
Okay, so people felt a bit better off.
In many cases, yes. Though it's worth noting, in some places, real wages are still below where they were back in 2019.
Right, still catching up. But you mentioned things might be peaking.
The pace of employment gains started to slow down later in the year. That suggests we might be hitting a plateau.
So maybe unemployment starts ticking up in 2025.
It's a possibility.
Yeah.
But the picture is quite different in developing countries.
How so?
Much more challenging. Youth unemployment, for instance, is a really persistent, serious problem in Latin America, North Africa, South Asia, Western Asia.
A very different story.
Definitely. You see contrasts like Brazil and India showing robust employment growth.
Uh-huh.
But then in much of Latin America, job growth is weak, and often just in the informal sector.
Yeah.
And many African nations are really struggling to create enough jobs for their young, growing populations.
And Europe had its own unique situation, didn't it?
Yes, the EU is interesting. Employment numbers went up, but the average hours people worked actually went down.
Why was that?
Initially, linked to more part-time work, but more recently.
Yeah.
It seems to reflect companies doing what's called labor hoarding, keeping staff even if sales are weak.
Right. Hanging on to workers.
And also, individuals making choices about work-life balance, opting for fewer hours.
Interesting. And Russia.
Record low unemployment reported there, around 2.3% in October 2024. But at the same time, tightening conditions for migrant workers.
Wow. So a really complex, varied picture globally on jobs. Okay, let's shift again. Investment and trade. How did they fare?
A modest improvement in global investment. Estimated growth of 3.4% in 2024.
Modest. Okay. But varied again, I bet.
Very varied. The U.S. saw pretty strong investment across different sectors.
Right.
Contrast that with Europe and Japan, where investment activity was weaker.
And developing economies?
Some did well. China, India, Mexico maintained pretty solid investment growth. But Africa, many countries there face constraints because of high public debt limiting government investment.
Debt again. Okay, and trade. After the slowdown in 2023, did it bounce back?
It did rebound somewhat. Global trade volume grew an estimated 3.4% in 2024, mostly driven by goods trade picking up.
Ooh, good well.
Strong export performance in machinery, electronics. Think China, the U.S., other East Asian economies.
And Europe.
Broad declines in exports, actually.
And commodity exporters, Africa, Latin America.
The value of their exports decreased because commodity prices weakened. So even if they shipped similar amounts, they earned less.
Got it. But services trade.
That was a bright spot. Grew strongly, estimated 6.4% in 2024. Services now make up almost a quarter of all world trade.
Wow. And tourism.
International tourist arrivals almost fully recovered to pre-pandemic levels, about 1.4 billion arrivals in 2024.
That's huge. Good news for many economies. But the outlook for overall trade in 2025, still uncertain.
Very much so. The baseline projection is 3.2% growth, but that comes with a big asterisk.
Geopolitics to trade barriers.
Exactly. Rising tensions, new barriers popping up. It makes the outlook quite fragile.
Those tensions are a constant theme, aren't they? Okay, let's talk money flows. Cross-border financing and debt. What happened there?
Well, after stagnating since 2022, cross-border financing flows actually picked up in 2024.
Oh, how so?
If you look at combined dollar and euro credit, going to borrowers outside the U.S. and Eurozone non-bank borrowers specifically, that level matched the previous peak back in 2021.
Interesting. So more international lending happening.
It seems market conditions improved enough that some borrowers, including some African sovereigns, could return to the Eurobond market.
That's positive. But not for everyone.
No. Many of the least developed countries, the LDCs, are still facing severe debt distress, big problems paying what they owe.
And the overall global public debt picture, still concerning.
Very much so. Global public debt is estimated at around 95.1% of global GDP by the end of 2024. That's incredibly high.
95%. Wow.
And the real kicker is the rising cost of servicing that debt, paying the interest.
Which hits developing countries harder.
Disproportionately so. They're spending a much bigger chunk of their government revenue just on interest payments compared to developed nations. It crowds out spending on health, education, infrastructure.
That debt burden feels like a massive anchor. Okay, let's dive into something crucial for the future. Critical minerals. Lithium, cobalt, copper. Vital for the energy transition. Investment is up, but enough?
That's the crux of it. Investment is rising, yes, but nowhere near enough to meet the projected demand by 2030 if we want to hit net zero targets.
So shortages are likely.
Expected supply shortages for key minerals like lithium, cobalt, copper. Yes, unless investment ramps up significantly and fast.
And that could slow down the green transition.
Absolutely. It could become a major bottleneck, potentially delaying climate goals by years. It's a serious concern.
What's holding back that investment? It sounds like a huge opportunity.
It is, but there are major hurdles. First, these mining projects need massive upfront capital, huge investments, and long lead times. Getting permits, environmental checks, actual construction, it takes years. Then add regulatory hurdles, political instability, especially risky for investors in some developing economies.
Sure.
Plus, technological uncertainties in extraction and processing, and the fact that prices for these minerals can swing wildly. It all adds up to a risky proposition for investors.
A complex web of challenges. So what can developing countries that have these minerals do to manage them better?
They need a really coherent macroeconomic strategy, integrating fiscal policy, taxes, and spending with monetary policy.
Like setting up solid tax systems.
Essential to capture a fair share of the revenue. And stabilization funds can help smooth out the bumps from volatile prices. Good coordination between the Treasury and central bank is key.
It's not just about the money management, though, is it? Industrial policy plays a role.
A huge role. Strategic industrial policies can attract investment, push for technology transfer, build local capabilities.
How? Through things like tax breaks.
Tax incentives, subsidies, yes. Also setting local content rules requiring a certain amount of local input supporting R&D.
Is there one best approach?
No single blueprint. Each country really needs to tailor policies to its own situation. But we know local content rules work best when they actively help domestic suppliers get better, not just mandate purchases.
The reports mention different strategies: Chile, Bolivia, Argentina.
Right. Chile is using state-led public-private partnerships. Bolivia has much stronger state control. Argentina is trying a more private sector-led approach with new incentives.
So government incentives are pretty crucial everywhere.
Generally, yes. Fiscal benefits, financial support, they're often vital to attract the investment needed for both mining and processing the minerals.
And another issue raised is illicit financial flows. Money disappearing from the sector.
Yeah, that's a big problem. Needs stronger governance, international cooperation, closing regulatory loopholes, better agency coordination, participating in things like the EITI, the Extractive Industries Transparency Initiative, helps bring things into the open.
And beyond the finances, what about the people and the planet, human rights, environment?
Absolutely critical. Policies must protect human rights, uphold labor standards, fight child labor. Meaningful engagement with local communities is essential, getting their free, prior, and informed consent, sharing benefits.
And sustainability standards?
They're proliferating. Stakeholders, buyers, investors, consumers are demanding more transparency, more ethical practices.
Is that easy to implement?
It can be tough, especially for smaller mines in developing countries. The costs, the complexity, it's a challenge.
So international cooperation could help there, harmonizing standards, providing support.
Definitely needed to help smaller players meet these rising expectations without being pushed out.
One last point on minerals. This idea of geoeconomic fragmentation. Countries going it alone.
That's a big worry. If nations focus only on their own supply chains, using unilateral actions, export bans, things like that,
it messes things up globally.
It can lead to really suboptimal outcomes, distorts trade, distorts investment, and could actually delay the clean energy transition for everyone.
Who loses most?
Projections suggest developing countries, especially low-income ones, could face disproportionately large losses from that kind of fragmentation.
So cooperation is the answer.
It's crucial for fair access, sharing technology, distributing the benefits justly. Trying to build walls around these resources won't work in the long run.
That's a really vital point. Okay, let's zoom in quickly on some regional highlights before we wrap up. The U.S. economy seemed like a standout.
Relatively speaking, yes. Its recovery from the pandemic was remarkably strong compared to many other developed economies.
But still facing issues like housing.
Oh, yeah. The housing market there is still very tight. Strong demand, limited supply, keeping prices and rents high, even with the Fed raising rates.
And Europe, facing some competitiveness challenges.
That's a major concern highlighted by the European Commission itself. They point to years of insufficient investment, some impacts of austerity, regulatory burdens.
And the energy price shock.
That was a big hit, especially in 2022. It forced some energy-intensive industries to scale back production, rethink investments.
And governments there tightened their belts in 2024.
Most pursued more contractionary fiscal policy, yeah. Phasing out the energy support and inflation relief measures they'd put in place. The long-term competitiveness issue remains, though.
Okay. Economies in transition, CIS, Georgia. Better than expected.
Growth there in 2024 held up better than forecasts initially suggested. But it's expected to moderate in 2025.
And Ukraine's exports.
Agricultural exports were obviously hit hard by the war, but finding alternative routes has helped stabilize things somewhat, which also helped global food prices.
Good. And a final sweep across developing regions, Africa, Asia, Latin America. Very diverse, I imagine.
Extremely diverse.
Hmm.
Africa's growth is projected to strengthen a bit, driven by recovery in some larger economies, but huge challenges remain: debt, unemployment, climate impacts, and extreme poverty has actually been rising there recently.
Worrying. East Asia.
Did well on the export front, especially machinery and electronics, as we mentioned. Growth is moderating there. It's a structural shift towards more consumption and services. They did roll out some policy support late in 2024.
South Asia. India leading the way.
Near-term outlook looks pretty robust, led by India, yeah. But risks remain. Geopolitics, slowing global demand, debt, climate hazards.
And Latin America, still grappling with debt.
Very much so. High debt, rising interest payments. It really constrains their ability to invest in sustainable development, a recurring theme.
It really is. All this makes achieving the Sustainable Development Goals, well, it still feels like a long road.
Progress is definitely insufficient. It's good news that global extreme poverty got back to pre-pandemic levels in 2024, a reversal of the pandemic setback.
But food insecurity.
Still higher than in 2019, particularly in vulnerable countries, and climate change is making it worse.
The UN had that Summit of the Future.
Yes, in 2024. They adopted the Pact for the Future, trying to reinvigorate international cooperation, speed up SDG progress.
And reforming the financial system was part of that.
A key part. A call to make the global financial architecture work better for developing countries.
Which brings us back to international cooperation, needed more than ever, but under strain.
Exactly. It's absolutely vital for tackling debt burdens, expanding concessional finance, making debt restructuring work better.
And for growth potential.
Yes, helping developing countries achieve their full potential, addressing power imbalances, giving them a stronger voice in global decisions.
Okay, so summing up, we've got this picture of moderate global growth, but with huge regional differences. Inflation and monetary policy are in flux. Labor markets are mixed. Trade and investment show some recovery, but face headwinds. And critical minerals are, well, critical, but face major hurdles.
And while extreme poverty globally has recovered, vulnerabilities persist, especially for developing economies grappling with debt and climate change. Uncertainty is high.
Geopolitical tensions, trade barriers, climate change, these are significant downside risks, which underlines, again, the urgent need for stronger, more effective international cooperation. It's essential.
Which leads us to a final thought, something for you, the listener, to consider. Given how deeply interconnected all these factors are, trade flows, interest rates, climate action, mineral supply chains.
Right, it's all linked.
What single area, if you had to pick one, do you think holds the most potential right now to either significantly accelerate or seriously derail our collective progress towards a more equitable and sustainable global future?
A tough question. Where's the biggest lever or the biggest potential roadblock? Something to really chew on after hearing all this.